Back to the Rosehart Show. We're live again for another episode, another week. Today actually, we are going to talk more specifically about what's been going on in the world and in the US related to this recession, this great reset that we're sort of going through right now. And today at 2:30, the Fed came out and had some very interesting language. Of course, I think you probably all know by now, we saw 0.75% rate hike in the US. The reason it's so important that we track what the Fed is doing in the US is they set the standard for the world. Because they are the reserve global currency, other markets have to follow suit. So Canada will then have to continue to hike as well and match. If they don't match the rates, the currency collapses. So Canada needs, for both import and export, currency is very, very important. So it's really tied to the whole economy. So in this video, we're going to talk a little bit about the Great Reset, and I don't think it's going to be as extreme as the book gets into and as some people allude to and talk about. But we are in for a bit of a tough time ahead. And there is definitely a rock and a hard place. And the Fed is trying to land the plane between the rock and the hard place. The hard place being the, Great Recession, or basically economic collapse that results in, or is a direct byproduct of the tightening basically they're doing to the economy by not stimulating and also by raising rates, which directly crushes businesses, basically destroys jobs, leads to layoffs, further recession, real estate crashes. Pretty much every business just goes in the shitter. So that's kind of the hard place. And then like the rock and the hard place is like basically if they don't do that, inflation runs wild like it has. We've had 10% inflation, real inflation closer to 20% in the last 12 to 18 months, which is unreal. That is not, no one can function in a world where there's that kind of inflation, especially if you live in an area where the tax rates are high, because inflation destroys wealth and increases revenue for governments. Governments love inflation, by the way, because if you have a house worth 100 grand, it goes to our stock, it goes to 150. You now have a $50,000 capital gain that isn't even real because they just inflated the value of it. You have the same buying power, but then when you sell it, they tax this new capital gain that they've created for you by printing money. So printing is great because then they get to take a portion of all the assets and you have less than you had before. And they're happy because they have more control and more than they had before. And the person at the bottom is also suffering too. Even if you don't have any assets at all, at least if you have assets, you can ride the wave with inflation. But if you don't have any assets at all, then unfortunately, your wage will basically destroy any value that it had if we keep inflation up for the coming months. And this meeting was actually very, very important because we saw some language about the long-term Fed funds rate increasing. We were thinking it was going to be 4.5%. They're talking about this now going on for another year, potentially. First, it was transitory. It's not transitory. Now, all the data is lagging, so we're not sure how our increases are going to affect things. Oh, I'm not sure how this is going to play out. A lot of very unsure language. And to me, that creates instability. The market immediately after he spoke, basically yin yang from, it was up, I think 0.75% to down 3.5% by the end of the day and still moving down after hours. We are now, the NASDAQ is down 34% on the year currently, trending down lower. Crypto's lost 60-70% of its entire market cap, all the value destroyed. Real estate is now next. Here in Ontario, we've had a 30 to 33% pullback. So if you had a property worth $1 million, it's now worth 700. We've seen basically a 30% rip off on the value, a little bit more than that now. We saw a little bit of a bounce, but it's going to continue down. There will be, what we call bear market recoveries. There'll be some cash buyers that scoop in and try to buy the dip, and then it keeps dipping. If you've been following my Instagram stories on Instagram, Mike Rosehart, I've been messing around with some reels, and I did a little reel on the dippity dip and how it continues to dip further. By the way, if you have any questions, throw them down below. As always, like we do every week, I will answer all your questions related to any of this to the best of my knowledge. I'll try my best to take a stab at it. So see you in the comments. But it's interesting. I'm short. So full disclosure, I am short the market. So I made $125,000 today because I am inverse the market 2-to-1. So as the market rips down, my portfolio has been ripping up. It's been painful to stay short, but macro data, it doesn't lie. We aren't seeing the job loss yet. The economic numbers are strong, which means the Fed needs to tighten even harder. But as they tighten, the problem is the data is lagged, like he's mentioned. We're talking about the Fed's mentioned several times now. We won't know the effects of this and the wealth effect. When you destroy a third of all wealth, trillions of dollars of wealth wiped out, that has trickle-down effects on the economy later. People get fired, 3 months, 6 months from now, we have hiring freezes. Apple's come out and had a 1-year hiring freeze. Every Meta, Google, everyone's come out and said they're either firing or freezing, which they should. In a recession, by the way, guys, my catchphrase, every single YouTube show for the last 5 years, I've said, spend less, earn more, and maximize returns, right? The first lever is spend less for a reason. You need to rein in your spending, and it's less important if you have a really robust growing business. Like if you're growing, 10%, 20%, 30%, 40% year over year, then it's more important to focus on maximizing that growth and that revenue. But once things start to contract, it's really important to watch your bottom line. I love the bottom line all the time. I've always been a cost control guy. It's just who I am. But I think it's important to be efficient with your time. So that's why I talk on this channel ad nausea as well about, you've seen my evolution. I did a lot of videos 5 years ago about how I was super frugal, how you could live a really kick-ass middle-class life instead of spending back then 5 years ago, inflation adjusted, 50 grand a year, you could spend 24 grand a year and accomplish the same thing. I think with inflation, you probably need to spend 36 grand today to accomplish the same thing I could do for 24 then. Thankfully, all of the assets have ballooned in value. And so if you're early retired, you're a lot richer than you were before, especially if you applied a little bit of leverage, a little bit of cheap debt. You took advantage of the cheap debt the last 5 years. Even today, I think that real estate prices have the ability to, there could be a bounce, I think. We could be at a low. There's a real possibility that inflation persists and we go through ebbs and flows where the Fed kind of takes a break, pauses, waits for data. We end up with a price wage spiral. What I mean by that is let me give you an example. Okay, so this is a real example. My daughter goes to a school just around the corner, a Catholic school, and the whole board is all of the custodians and janitorial staff and all the support staff and ECE workers and all of that. They're going on strike. And they're demanding right now that the Ontario government here in Canada pay them an 11% wage increase for the next 5 years. So they want a 55% wage increase over the next 5 years. And they're citing current inflation data. And they're saying, hey, we don't think the government's going to get this under control. The problem is they're going to shut the schools down until they get what they want. They're going on strike, right? And so, of course, the government may have to bend. They'll probably get some negotiated inflation, like maybe 7% for the next 5 years. And businesses are doing this, if businesses are giving out these crazy wage increases to combat inflation, what you get is in the next year, when they're enjoying that extra income, they spend more. And so demand goes up. And if you don't fix the supply side problems, even if you do fix the supply side problems, if you give everyone more money, you get a wage price spiral. So next year, as we think rates are supposed to come right back down, they might not, because all the people who are still employed are going to have 10% more income than they had before. And so they're just going to spend more. The whole point of raising the rates and to stopping the stimulus and basically contracting the spending is the government's trying to reduce demand. They're trying to say, hey, we want to make it so you can't afford that vacation. You can't afford that rental property. You can't afford that new or used car. You got to go a little bit cheaper. And as demand, retracts, then prices fall. It's just simple supply and demand. And that's what they're trying to do. In a bull market, everyone's got money, everyone's going on trips, everyone's living on high on the hog. In a recession, people tighten, right? When you're afraid of losing your job, when your wages aren't going up. So there's a real challenge, I think, that we're going to face over the next couple of years. And it's a real possibility that real estate, and I think Ontario's corrected quite a bit. There was a lot of fear in the market. Rates have, jumped. I kind of wanted to start the episode with this, but I didn't. 6 months ago, on my live stream, I was like, the US is going to 10% mortgage rates. And I got so much shit for that. I posted it on Instagram stories, and I had dozens of people back then when rates were creeping from I think they went from 2.9 to 4. And I had a bunch of real estate gurus and people that I know that have a lot of properties and stuff, and they're all trying to raise capital and whatever. And I get they have inherent biases. And everyone in the industry is trying to raise capital or whatever. Right now it's hard to raise capital. So I get that business owners and real estate investors are trying to be positive and maybe a little too positive, a little too, everything's great. It's going to come back. Kumbaya. I like to be real. And I also raise capital, and I also continue to do deals. I'm still doing deals now. I'm ramping up. We have 8, 9 flips going right now. So I'm actively in the business, but I'm very calculated in my decision-making numbers. But anyway, at that time, people were like, it's never going to 6 or 7%. I'm like, 10% is ludicrous. We are going, mark my words, we are seeing 10% mortgages again in the US in the next 6 to 9 months. They are currently at 7.7. After today's hike, 8.6. The next hike will take us to 9.5. We will see 10% mortgages. 10% mortgages on the average house in California at $1 million. In any major metropolitan, pick New York. I don't care. It doesn't have to be California. You could pick Miami, right? Whatever. $700,000, $800,000 houses. You're talking about mortgage payments of $5,000, $6,000, $7,000, $8,000 a month, $10,000 a month. It makes no sense. cap rates don't make any sense because remember, cap rates are before debt, before leverage. So you're buying properties in major metropolitans right now at a 4 cap, a 3 cap, a 5 cap. That means your total return is 5% before you apply debt. If you apply a mortgage, and by the way, real estate and business relies heavily on mortgages, on debt. People don't do deals in cash. Doesn't make sense. Not a good use of capital. They love leverage. They love debt. Just the way that the business works. So debt is inherently a large part of how we derive value and how we derive cash flow from these deals and how we analyze these deals. And so if you're buying right now in New York at a 3 cap, if you're buying in Vancouver at a 2.5, 3 cap, in Toronto at a 4 cap, and you're borrowing now, let's say in Miami, where mortgage rates commercially can be 8, 9, 10%. And we're going to see 10%. Mark my words, it's coming in the next 6 months. It is not over yet. Rates are continuing to rise. In December, the Fed said today, in the December meeting, they're going to start talking about stopping or pausing the rate hikes. So we could be in for another 3/4 rate hike. So it could go from 8.5 to 9.5, pretty close. One more hike in the spring and we're at 10. Remember, it takes another year to get the rates back down again. So that means we're not looking at low rates like we had earlier this year for at least another year after that. We're talking 2024 best case scenario. Rates start to come back down to where they were. Best case scenario. And that's if there's no stimulants. That's if we go into a bit of a recession and people start suffering. And while the Fed is trying to tighten, the politicians all hear the crying of everyone who's lost money and suffering and saying, hey, can you stimulate us? Can you give us some money? In Canada, they're doing that now. They're handing out GST, HST rebates. They're handing out child benefit rebates. They're handing out tons of money. They just announced more money that they're handing out to help with utility bills and all these other things. When you do that, you create more inflation. When you print money and you hand it to people, you're defeating what the government's doing, politically trying to appease their voter base by giving out money. They're printing money that they don't have. And they're doing it by basically robbing from the Fed, who's at the same time, they're supposed to be independent. Their job is to fight inflation. So there's it's a challenge because the people want it good now. Everyone always wants what's great now, and they don't give a shit about what happens later. Inflation's a lot like, I shared a post today on my Instagram stories at my Rosehart about inflation being a lot like alcoholism. It's great in the beginning, but it always sucks in the end, right? It feels good in the beginning, but once you get to the end, there's always negative latent effects. And it's the same thing with inflation. So anyway, I think we're going to go back and forth. I think at a certain point, the Fed's going to pause. And when they pause in the spring, we'll be around 10%. I think at the peak, we'll see 10% mortgage rates. It could get worse. I don't think it'll get much worse than 10%. Deals can still cash flow, by the way. I'm seeing lots of properties that still make sense, 10% mortgage. I've been doing flips for a long time with private money at 9, 10%. No problem. I run my numbers and I buy my deals at enough of a discount. I can operate in that space. I operate efficiently, and good operators in this space will be able to continue to flip properties, will be able to acquire properties. And if you can hold through this time quality properties, again, I don't think holding is necessarily always the right decision. I think for a lot of people, once you've maximized the value of the property, it does make sense to dispose of that asset and move on to the next one. Net of tax consequences, especially if you're in the US and you get the 1031 exchange, then it makes sense to move on to another deal because you can continue to basically jump from deal to deal, maximize the value of each deal, and you end up with a lot more capital and a lot better return over the long term versus holding a property. Most of the wealth that I've made in my life has been on the buy and then the transformation. I don't make a lot of wealth, and I've analyzed how I've made my money, and it was sort of a eureka moment. I was like, geez, I actually make almost nothing from the buy and holding, like a couple $100 a month, $1,000 a month, whatever, the miscellaneous expenses pop up here and there. The cash flow isn't really what gets you there. Over a lifetime, it will, sure, but I made leaps and bounds better returns in the buy. So immediately when I close it, every property I close, I should be able to sell it for more than I bought it for. That's rule number one. If you can't currently sell the property you just bought on the open market for more money, you overpaid. So if you're buying an MLS at market price, coming in at appraised value, that's a problem. You got to change your strategy about how you're buying. Be a better buyer. And if you're not going to be a better buyer, maybe just buy into REITs because they'll do it better than you at scale. If you're going to outsource property management, what you're going to find is that the property manager doesn't care about the property as much as you. They're not incentivized for you to have a profit. They want to make placement fees on tenants. They want to make management fees. They want to make a markup on maintenance. That's their focus. They don't really, they don't get a whole lot of value from they just don't get a whole lot of value from you. Their incentives aren't aligned. And so if you don't have a competitive advantage in the buy and hold space, and my only competitive advantage I found currently not being at scale, unless you have in-house property management, and if you have in-house property management or you're doing it yourself, you can develop a competitive edge. You can get trades in there for $35 an hour to fix a plumbing mistake. Whereas my property manager will charge me $100 an hour. They'll just call the most reliable person, get them to come out. And if you get property managers doing that, at scale, you lose money, right? Like you need to be efficient in this business to make any money. Landlording has very slim margins. You make most of your money on the buy. Like if I buy I say, hey, I'm buying whole guy because I buy really great deals. Okay, awesome. But if you look at that deal over say you owned it for 3 years, over those 3 years, minus appreciation, because we're not betting on appreciation. Remember I talked about last stream and the stream before that, I talked about how we're going into a different economy than we were in the last 5 or 10 years. It's very likely that we have more of a flat market like we did in the 90s. From 1991 to 2001, in almost all of Canada, prices were flat. If you bought a house in the early 90s in Toronto, by 2002, it was worth the same amount of money. You held it for 10 years, you made nothing. That's what landlording is really about. In London, Ontario, if you bought in 1994, by 2014, 20 years later, your house was still worth about the same. It lost out to inflation. In a lot of markets, real estate loses out to inflation. People won't talk about that. However, if you apply leverage to your deal, you get cheap debt and you put 20% down, then your capital, your 20% base, if you keep refinancing it and you don't let your mortgage pay down because you don't want to pay down your mortgage. That's okay. For the first time ever, I'm going to say it might make sense to pay on your mortgage at 10%. But when it was at 3%, 4%, 5%, 6%, it didn't make sense to pay it down, right? Because you get a better return elsewhere. It's just not a great use of your capital. You want to be levered up on these deals. If you're borrowing at 6%, 7%, I'm hoping you own deals that are 10 cap rate. I hope it's not against 4 or 5 cap rate or 6 cap rate at market value deals. I'm talking about at market value, by the way, guys, because if you bought a property, fix it up, it's great. You're like, hey, I have a property in Toronto. People message me all the time. They're like, hey, Mike, I got a property in Toronto. I fixed it up. It's beautiful. I got it for a great price. I'm gonna lend it for like 800 grand. I'm like, that's amazing. You're making like 7 grand a month in rent. That's awesome. You're almost 1% rural Toronto. And I'm like, what's property worth right now? Like, 2.5 million. I'm like, wait, so would you buy that property for 2.5 million? Like, no, never. That's a ripoff. Like, I'm like, but you're continuing to hold it. You're holding a property that's a 4 or 5 cap rate. And that's the same as buying it. When you hold an asset, you're choosing to, minus tax implications, by the way, because I know some people have crazy tax implications, but there's definitely something to be said about, when you choose to hold something, it's very similar to choosing to buy it. And so if you continue to hold a 4 cap, your average return drops significantly, especially if the cost of debt is higher than the return on asset. What you always want is the return on asset, the cap rate, to be much higher than the cost of debt. And that's inversing for the first time in a long time in a lot of markets right now. And that's why it's scary, because investors are speculating. And I've always said, as a practitioner in real estate, I try to be a professional in real estate. I have to hug tight to my numbers and stay true to my values. And one of my core values is I don't want to own any asset that can't self-service, that can't carry the debt against it. Because then you're putting money into the project, and that's not a good long-term proposition. For a short-term flip, sure. So anyway, that's why I think it's important that we analyze the deals we have, take your ego out of it. Because a lot of real estate investors have their ego stuck in their properties. They're like emotionally attached to it. Their grandma lived in the property. They renovated it themselves. It was their first deal. I hear this all the time, right? A bunch of ego. And then another ego piece is a lot of flippers right now are stuck in the ego mindset saying, hey, my property's for 600,000. And then they're messaging and it's like, hey, I have so many realtors calling me and be like, hey, this property's stale. Do you have anyone for it, Mike? Do you know anyone who would buy this? And I'm like, no, because it's overpriced. Drop it 30%. And they're like, oh, no. Like, it's not down 30%. I'm like, look at the data. In London, Ontario, it's down 30%. If it was worth 800, take 30% off. That's $240,000 off. It's now $559 list price. It was 800 before, now it's $559. Drop your price, take your ego out of it, and sell your property. Move on to the next one. If you're a good real estate investor, you can find another better deal to move that capital to. And the hope is that when you buy that next deal, that you make more than if you had instead held that property. And so you continue to cycle through buying and transforming properties, unlocking the value, and then cashing out and getting out of the next deal. If you had unlimited capital, I would say hold. Like if you got someone, and I had one investor reach out to me and it's like, hey man, I got a blank check for my parents and I can buy as many properties as I want, I just can't find enough deals. And it's like, okay, in that situation, maybe it makes sense for you to hold. Maybe it's okay to get a 6% or a 6 cap property and keep that in your portfolio for tax reasons because you have unlimited capital. I personally have to redeploy capital. Even I may have a lot of capital. I could probably buy quite a few deals, but it still doesn't make sense for me to keep property in a portfolio if it's doing a 6 cap. It just simply doesn't make sense, right? You've got a situation where, if you're holding something getting a 6% return, that's lackluster. You can go buy inflation-adjusted bonds right now in the U.S. that pay 8%. You get 8% from government-backed bonds. Why would you hold a property and make 4? What? And then put all the work in? Do you know how much work it is to manage a manager? Even if you've outsourced it. You can still get called to the landlord-tenant board to testify. You still have to manage, the manager's going to text you, is going to message you. There's still back and forth. There's tax returns. There's bookkeeping. There's all that crap you got to deal with. I would much prefer to have a bond. So anyway, I just think it doesn't make sense to hold properties right now or buy properties in those markets where the numbers don't make sense. So anyway, I'm gonna go to the question and answer for a sec here and see if, I've pissed anyone off or, see what people have to say. How's it going? Steve, how you doing? Eric, how you doing? Michael says, I seem to always miss these lives. Congrats again on holding that QQQ short. Thank you, Michael. A lot of people, though, the last 3 weeks were coming at me in the comments being like, I had some traders being like, are you sure, man? Like, things are not looking good for you. Like, you've made some really bad decisions shorting the market. And it's true, by the way. My timing is horrible. And by the way, most people's timing is horrible. Statistically speaking, most traders don't outperform the market. Most investors don't beat the market. That's why I say buy the market. Don't try to beat the market. If you have a business, like you're in real estate and you're operating a business in real estate, then you probably can get some crazy returns because you can put in time and you have a competitive advantage. Most of us don't have a competitive advantage in trading. I'm right now trading as a hedge against my real estate portfolio, against my other investments, my businesses. That's why I'm shorting. Is I'm like, you know what? The macro data doesn't look good. I feel like there's more pain ahead and it's very likely. So I held this short and today it paid off big time. 125 grand up today. In the last week, I'm up like 200 grand. It's going to be another 200 grand as I continue to hold this short towards the bottom. Then I'll close out my short, probably stay neutral in cash and wait for opportunities to buy. I did last week buy Meta. Oh, earnings was down. If you watched last Wednesday, I bought I have a $450,000 position in Meta and it sucks because it's pain. But I love the company. I love what they're doing. I think WhatsApp, Instagram, Facebook, I think that is, it rivals really only to Twitter. And I love what Twitter's doing. I wish Twitter was publicly traded. They went private. So you can't even, if you had shares, you probably would have lost money by buying and getting bought out. But it's privately traded. So you can't even invest in Twitter right now, technically. But yeah, I think that they have a huge user base. Half of the world uses one of Meta's products daily. Half of the world. There are almost no other companies that can say that have that kind of eyeball attention too. Like you might have a Coke and look at Coke like, oh, great, Coke. It's a great brand. It's been there for a long time. A lot of people like Coke. I hate Coke. I think it's disgusting. But I get the allure that people love it and whatever. It's a great brand. Meta is still early and still new, but they control like 8 hours a day of our eyeballs, guys. And I think as a company, they're a cash machine. They're like a 7 or 8 P. I have to check, but like maybe an 8 P ratio right now. I think that there's, they have a lot of opportunity to go deeper in the channels that they're in. And I would love to see them monetize Instagram. I would love to see them have a paid verification for Instagram. I've applied for verification on Instagram twice, got declined both times. I applied once on Facebook. They gave me the blue check mark. Like, yeah, you're a celebrity. You've been on you've been on live TV in the United States. I was on the Tamron Hall show, right? And then I ran viral in the UK. I sent some links. There was like 20 million downloads about talking about how I was, super frugal and like we banned my wife from Starbucks and this whole early retired thing. This was a few years ago, but I was like, I have a lot of media presence and I applied. Facebook was like blue check mark, no problem. The same company, Facebook and Instagram. Instagram says no. You know why? Because I'm on ban for sharing the pandemic stuff on Instagram and I still have a warning on my account. That's why they won't give me the blue check mark. They don't like that and I was pretty clean about what I shared. Like I wasn't even crazy out there. I was like, hey, let's question some of the government policies here and some of the lines that are being crossed, right? And I was like, whoa, no, you can't do that. Like question something? No. Not relates to medical science. You don't have a medical degree. It's like, okay, do I need a medical degree to write policy? Most of the guys writing policy in the government didn't have medical degrees. And the ones that did were highly influenced, I think. Anyway, I'm not going to get down that rabbit hole because I don't want YouTube to also throw me in the shitter. I'm going to go back to the Q&A for a second here. Next one. Jazz Raj says, how long do you think the real estate market will take to recover to February 22 prices, 2024, 2025? So we saw a euphoria in the market from like November 2021 till March 2022 that we hadn't seen ever. We had in some and real estate is very local specific. And so what I mean by that is like Florida, as an example, is still flat. Year over year, it's flat right now. Whereas Ontario is down 20% or so. So there's vast differences. And if you're in a different market than me, it might be totally different for you. If you're in like New Brunswick, where there's like $150,000 houses, your market might be flat. It might be unchanged entirely. Some markets are more affected than other markets, right? And like as an example, Miami is a heavy cash buyer market with a lot of foreign buyers that bring capital there and preserve it because their currencies in El Salvador, Argentina, or Venezuela are collapsing. And so they're like, hey, it's safe in Miami. We can park it in US real estate. The government will bail us out. It's a safe place we can park money. So and drug money and everything else. So there's a lot of cash that keeps those markets propped up, even if rates get crazy and whatever. So it's very market situational dependent. So it's hard for me to make general statements. But I think that we can safely say that the euphoria that we felt during that period, by the way, I bought nothing from September 2021 until almost this summer. So I almost didn't buy any properties for almost a year because nothing made sense. The euphoria and the speculation was just everywhere. I couldn't find a deal. Even in Florida, it was just so crazy. I couldn't find a deal that made sense to me. So anyway, I'm just going to say that. I now feel like we're in a much more balanced market. You can negotiate, you can put in terms that you couldn't before. So we're in a different market now, even in Florida, especially here, where you get great discounts on properties. 1% real properties are coming back again. I just bought a triplex with my cousin on MLS for $363,000. It'll rent for almost $5,000 a month, $60,000 a year. We're talking almost 2% rule on almost old South London, like in a decent, nice area. What? Needs some renovations, but like that would have been $600,000 in February. So that we've almost seen in some pockets you can negotiate almost 40% drops in price. So to me, that signals that like maybe it's oversold a little bit. Maybe there's some opportunity here. Same with Meta, and I could be wrong by the way. When Meta shares trade at $70 a share, I'm sure I'll be pissed that I bought it at 92, right? But I think Meta, again, oversold. The whole metaverse piece, I think that company in the next 10 years will be revolutionary. They're spending the kind of money that Apple spent to develop the iPhone. They're spending the kind of money that Tesla spent to develop the Tesla. They're spending at rates that no one's seen before. They're investing big time in this space. And eventually we will be in a virtual reality. We will work in virtual reality. I think there's a lot of potential there. I don't know if they'll be the one that cracks the nut, but I think if someone does crack the nut, they got $45 billion in cash on their balance sheet, and they're generating cash like crazy from their existing cash cow businesses with Instagram, WhatsApp, Facebook. And yeah, you can say what you want about the dinosaurs being on it, but the dinosaurs have all the money, right? Like the baby boomers, they have a lot of wealth. On average, like wealth really trends by age, right? You look at, you can map how the median and the average person's income is by age, right? So that's where the money segment is, and they're all on Facebook, and they're getting onto Instagram, hopefully, and they're starting to get on WhatsApp, and companies are using it, and anyway, so I'm not gonna get down that rabbit hole, but I think that there's a lot of potential in the metaverse, and it's the growth piece for the company. They're already a great cash cow business, but if things deteriorate, they're investing in the future, and I think the world will be in the metaverse. Crypto is, the technology is pushing us there, the NFT space, people are getting into the metaverse, so I like the company. I like real estate too, especially in London, Ontario. I think there's a great opportunity here. We may, though, be flat. We may not see 2022 prices until 2030. It's a very real possibility that we ride out like we did in the 90s, where they're fighting inflation and the rates stay elevated. The Fed's overnight rates are closer to, we're not talking about over 5%, right? We're talking about like the Fed's fund rate being like 5%. So it's an issue where like, will long-term growth be able to keep up with that? Because if rates stay higher than long-term growth for a while, we're going to be at a bit of pain, a bit of deflation, right? Which is, can be healthy and good, and you can make arguments for, but is painful for the real estate community. So I think that while real estate holds its value very, very well, there's a bottom. Like we've been bouncing off this bottom. The bottom being, well, for one, Canada, and someone just mentioned this right now, Mason just put in the comments, I was about to just say that. It's like you read my mind. Trudeau and if Trudeau stays in power, I don't know if he will after what happened through the pandemic. I think that there's a good chance that the Conservative Party led by Pierre will overtake him. But I think a lot of business owners and a lot of the average Canadians are frustrated with how Trudeau handled things. Usually, after something like that, we would see a new leader come into power. If that happens, then this immigration plan could be scrapped. So don't invest entirely on immigration, right? Because remember, the Conservative Party isn't as bullish on bringing in 3% of Canada's population every year until it's diluted to the point where, Canada's doubled in size over like 10 years, 15 years, with all people who are not Canadian, or I guess they've become Canadian, but I'm an immigrant too. You know what? Like we come over from Europe. My family, like my grandma came over on a boat. So it's like, I can't really, we love immigrants. They're good for the economy, especially if we bring in highly skilled immigrants. Well, rich immigrants are great too. We prefer rich immigrants because they bring a lot of capital with them and they develop and build businesses. And the big thing is that the immigrants that you bring in that are wealthy and educated, they contribute more to society than they take. Because remember, being a Canadian citizen, you get a lot. If you earn less than $90,000 a year, you take more from society than you give. Fact. Just on free healthcare, Canada Child Benefit, if you average it out less than 90 grand a year, you're a sucker on society here in Canada. That's fact. So I'm a contributor. But there was a time where I was a sucker. I was a sucker fish too, making 60 grand a year. I wasn't paying near as much as I was taking from the system. And so, yeah, when it comes to immigration, good for real estate, by the way. We have so one of the reasons I really like Ontario's real estate is, and Doug Ford has put out new rules, I talked about this last stream, that he's trying to allow more units. We're trying to get to a point where we're going to be able to allow 3 units inside of any property. There's still exemptions. If you're on septic, as an example, you get 1 unit. Even if you're in London, there's lots of properties that are exempt. There's lots of places where even this Doug Ford's new rules won't help. But in the inner cities, the idea is that anyone should have a lane house or a triplex or like a basement apartment, a main house, and a guest house. Like 3 units across the properties. That's good news. But still, most municipalities are like, that's great. We love that. More affordability, more housing. Let's build housing, but not in my backyard. So yeah, let's build housing, but not here, or here, or here, or here, and not here, and definitely not here. But you can do it over here. And it's like, and if you do it, we're going to charge you like 100 grand development fees, and it's going to take you 2 years. And you're going to lose your shirt trying to do it. And then we're going to throw the book at you. So that's been my experience, and every other investor I've ever talked to who's done any major development in London, Ontario, in Toronto. Toronto's a little bit better. Vancouver's the worst in Canada. And so there's a lot of red tape. Supply side, we have real problems. There are developers who have taken on big old conversion buildings and spent 9 years trying to get through the zoning, trying to get through all the site plan requirements, trying to get the building permits, by the way, because they can, the building inspectors, plans examiners come back with new things they want to see, trying to build old buildings to new codes, results in sometimes it's not feasible. Like you just can't get some of the requirements. Like you can't get an average 7-foot ceiling height in a basement that was built 100 years ago. And it might be you could make it a really nice unit. And some, Asian girl who's 5'1" is fine living in a basement that's 6'4". You know what I mean? Across the whole basement. It's like, that's fine. So there should be exceptions. And I think we should allow more housing. They don't want to do that. So on the supply side, we have a real supply side issue here in Canada. And now rates are crazy. The real estate market's falling apart. Why would builders invest now? Why would real estate investors put our money in and develop more units when it doesn't pay, right? So that there's the supply side issue. And you're right, Trudeau has a plan to bring in 400,000 and 500,000 immigrants to Canada per year. Our population's like what, less than 40 million? So that's like a considerable couple of percentage points of our population every year. If you do that over a 20 or 30 year period, Canada becomes instead of a 40 million population, 80 million or 100 million population. So we get pretty large. Luckily, we're a large country. We have a lot of natural resources. I love Canada. If I was going to bet on, any country, it'd be Canada, just bad management. Like if I just change out management, it's like I would just all day I'd buy it. I feel the same about Meta right now, by the way. I hate a lot of decisions Zuck's making and some of the management at Facebook Meta is making. They have so much potential under the right management. Anyway, Canada's the same way. So it's a tough environment to operate in. So another con, I guess, for Ontario is like, unless you do Airbnb, which is again why I have got my own Airbnb business, by the way. Luxury stays. So if you're in Burlington or Hamilton or KWC or Barrie, and you have a nicely renovated unit, you want us to rent it from you and put it on Airbnb and do corporate stays, monthly stays, we can get around the short-term rental stuff because we can do monthly stays. We can do furnished monthly stays where we get double the rent. And we can easily pay you market rent, have your place cleaned often, in much better condition, fully staged. By the way, fully staging a property adds 10 to 15% value to the property. So if you ever want to appraise it, or just in general, you want to refinance it, you've got a property now that's in much better condition, that the quality of the finishes last longer, and it looks better and appraises for more. I would never put a long-term tenant in a property that I was going to hold long-term. I would definitely always do an Airbnb, corporate retreat, VRBO, something medium-term at least. Medium-term rental is like a month or more. So medium-term rentals is the place I like to be. Corporate contracts, where like you sign a contract with Rogers or CN Rail, or you go through Airbnb and do the same thing with a company, because they're not there forever and they're easy to get rid of. And you can jump the rent whenever you want. If inflation runs crazy over the next year again, you can just jump your prices like that overnight. If there's damages, you have a credit card on file. You have insurance. You can call Airbnb, boom, boom, boom. The furniture's replaced, they cover it. You know what I mean? So it's a different world. And so I like real estate in that world. I don't love it in the long-term rental space where you're putting in a tenant that seems great, especially if you're not picking the tenants yourself and you're at the scale I am, where you're relying on property managers to make those decisions for you, then there's a lot of risk there that they don't place the right person. I had a recent experience with that where we had to get the person out and get a new person in, and it's a pain, right? Going through all of that is a huge time waste, a huge financial investment, and the landlord-tenant board is not in your favor as a landlord. It's definitely against you. It can take, if a tenant stops paying, they get about 11 months before they get evicted. Best case scenario, if you don't make any mistakes. That's all it takes to get the trial, and then eventually get the sheriff, and then get them kicked out. So they just say, no, I'm not going to pay, no, I'm not going to leave. It takes almost a year just to get them out. And that's without the whole pandemic stuff, because it was like 2 years, the pandemic. They're so backed up, it's not even funny. So if you're into real estate, do Airbnb. Hit me up. You guys know where to find me if you are interested in that at all. But yeah. Yeah, I think our email for that, I have to ask the boy. I have 2 operating partners that are mostly handling things. So I think it's info@luxurstays.com. That's the place you want to go if you want to hit that up. But I'm investing in that business because I'm putting my time there as well, because I like that business model. I like being able to, make a nice margin on properties. There's a lot of really, great properties you can rent, give them great rent. It's a win for the landlord. The landlord now has to not worry about property management because you do all that for them. They get a real passive investment and you can make a spread on that. So it's a lot like owning the property. It's like almost like, it's like JVing with me in a lot of ways, because it's like we're sharing in the profit together. And that's a huge win, because property management is not profitable. It's a shitty business to be in. I had a property management company. There you go. Someone just jumped in and said, Dick's Junk Removal says waiting 9 months for a trial date, LTV. I've heard similar experiences. I've heard a year. I had one where they got 9 months and then the tenant got off on a technicality. There was like a typo or something, or I forget what it was, but there was some technicality. They were able to stay for even longer. They had to reapply. Just a joke in Ontario. So anyway, I think the way to do it is short-term rental, medium-term rental. Students are nice too, because they don't stay for long-term. They're not especially if they're not from that city, why would they stay and try to hold the rent? Tenants are the reason we had this crazy rent spike where we had 25% rent increase. It was actually the leading contributor to inflation. And it's weird because they didn't adjust inflation properly to account for the fact that rents are up 25%, or that most people's variable rate mortgages double, or the fact that real estate prices were up 80% over 4 years. It was a joke. It was the CP lie, right? Meet Kevin says this all the time. He calls it the CP lie. I agree with that. It's very much fake. Go to check some shadow economic statistics on the shadow inflation, the real inflation. But anyway, my point there was that these tenants hold on to these units because you can only rent increase. Well, there was no rent increases during the pandemic, so expenses went up as they printed money, and you couldn't raise rent. So it's just flat. But then on top of that, normally you get 1%, 1.9% increase a year, and expenses were jumping, and property was jumping in value, and all this was jumping 5, 10% in a lot of cases. And so the distortion between what was market rent and 10 years later, what is market rent is they have units that they're now controlling, and you have no way to get them out, and they're literally at half the price. So yeah, that's the situation in Ontario. But going back to that original question, where do I think prices are going? We could see a bounce. It's a possibility that there is quite a bit of cash actually sitting on the sidelines. A lot of funds have capital and will buy, especially as properties continue to fall into below replacement cost. This is where I went hard in 2018, 2019. You guys remember I was talking about on my channel at nausea. I was there are deals in London, Ontario. I was buying houses for 180 grand with single detached houses. And I was you can't buy the land and build this for less than 400. Even if you discount the building at 50% depreciated, it was just unreal. And those deals are coming back. And I think that that's a place where you can buy and feel very confident. The building materials, if you're buying it for half of the cost to build it, and the land is free and it cash flows positive, that's where I'm really interested in real estate. And we're starting to get to that bottom now in certain markets. And that's where I'm interested, most interested to really, niche down and buy. Will we see a bounce from there on those specific properties? Yes. Could we be flat for a long time if rates stay high? Yeah. We could be battling inflation and high rates for the next couple of years. It's possible. In the early 90s, as smart as they were, things took a decade to come around. So that's a real, that's a reality, I think, that is possible. The only thing really working for us right now is that, the thing that's working for us, sorry, my kids are out there playing outside the door. The thing that really is helping us is that we are now in an information age where information transfers so quickly that things are like whipsaws and happen a lot faster than they did then. So in some ways, I think that could help things go faster and help things get better quicker. Okay. Let me go to the question and answer here and see if I can pick out some stuff. So I guess to answer your question entirely, um, I don't know. I could see an argument for prices. We could see a jump in prices, but I think it's more likely that it takes the next 5 years or 7 years to get back to the place we were. So I'm not rushing in to buy as many properties as I possibly can. I'll let you guys know when I think the bottom is. It'll typically be when the pain is at the most, when you can negotiate the deepest discounts. And the hope is that if market prices here at that bottom, when rates are at their top and we start talking about rates coming down, just around that time, it's sometime this spring, I'm hoping, maybe February, we should see a point where you can negotiate the deepest discounts. There will also be a really great buying opportunity as the market pivots and rates start coming down and prices start coming up, and we start seeing that price action coming up. You can use comps. Property takes what, 100, like real estate isn't liquid. It takes 120 days to sell something at best case scenario. 60 days on market, 60 days once you accept an offer to when it finally closes. 30 days preparing it for sale. You're like at least like 4 or 5 months to get liquid. So we're talking about 4 or 5 months lead time. So when prices do start to rise, we will see that monthly data. And well, I'll see that monthly data and I'll tell you guys. And what we'll see is that those old comps, you can use those to negotiate. Say, hey, this property just closed last week on the street and it sold for $350,000. That sold 4 months ago, but it closed yesterday. So it's a fresh comp, not a comp until it closes. Until cash changes hands, it's not a comparable property. So once it's a comparable property, it's lag data. So you can use that lag data to buy. So I think the best time if you're going to wait to try to time the market is exactly when the market starts to improve. When we see 2, 3, 4 months of, ideally 4 months of upward trajectory data, we see that we're beating inflation down. We see that rates are going to start coming down again. When the Fed stops talking hawkish and starts talking dovish. And by the way, this could be the reason I said there's going to be caveats here is because again, they could go dovish, be wrong, and overcorrect, and then stimulate, and then have to inflation get crazy because, like I talked about, the wage price spiral. When everyone's getting crazy in wages again, then inflation starts up again, right? You start lowering rates and people get euphoric again, and then prices jump, right? So what could happen is inflation comes back again, then rates come down again. So it could take a while. We could be like this for a while. It could trade sideways for the next 2, 3 years. Who knows? Again, that's why I say we got to be strong operators, cash flow focused, buying under market value. Those fundamentals of how to run a real estate business, how to buy real estate and really run real estate properly, you can run in any market. A down market, a sideways market, not market. A lot of people are coming out and talking about their losses, myself included. Like I've had losses too. I was lucky in that I cashed out a lot of properties that, not at the top of the market, but last year in 2021, I dumped a lot. And it wasn't the top of the market. I missed there 20% of growth, but I'm still better off now than if I had held those properties. And I'm cashed up. So I'm in a position where I'm very fortunate, but I'm seeing a lot of operators come out there and go bankrupt, default on prom notes, default on first mortgages, second mortgages, losing their shirt, going bankrupt. A lot of people not going bankrupt, but are close to insolvent right now. And just the general, consensus in the market is that flippers are losing their shirts. I know some really good flippers. I have like 5 of them that have talked to me in confidence. I'm not going to share who they are. I know people who are good, who you see and you think are great because they're always sharing how great they are. But behind closed doors are losing money. And these flippers are in a situation where they're doing deals and they're losing money. And if they've been in the market, if you're going to invest in one of these gurus, please make sure they have staying power. If you're going to private lend unsecured, if they haven't been in the market at least 7 years, for me, that's a no. I want an operator who's been in the market a long time. I want someone who's focused on cost control. So are they a spender? That's another thing. The spenders are going to go down in this market, right? The guys who bring in the most expensive contractors and live the most lavish life and don't focus on cost, before when they were flipping, they were able to be saved by the market appreciation. Or if they did a really good job on a property, they could get top dollar and it would sell quickly. In this market, as a flipper, you can't sell quickly. Even if you price right, sometimes it's going to take time to sell. Just the nature of the market. People do a song and dance and negotiate. Buyers aren't as quick to jump because they're like, hey, there's 10 opportunities. Let me try an offer here, try an offer there. I'm not in a rush. Prices are falling. Like, it's a party if you're a buyer right now. You can negotiate. You have some fun, right? You can throw some offers out and see what happens. I'm throwing offers out. We're doing 10 offers a week in Florida right now. Ish. That's what my target is. Some weeks less, some weeks 5. And we threw out a few offers yesterday, a few offers the day before that. We'll try to get to 10. But anyway, I'm throwing out a lot of offers. And I'm throwing stuff out at like 30% under. And people are considering it. No one's accepted me yet, but they're getting close. And someone's going to accept me soon. And I'm going to be able to get great discounts because I continue to go out there and volley people, right? So this is the time to be a buyer. Not a great time to be a seller, but if you have property right now and it's at a high interest rate, dump it. If you're holding a 4 cap, it might get worse. We're not quite at the bottom yet. You could still use comps from 4 months ago to sell your property for a little bit more. I'm seeing some variance in the market. It's weird. Like some properties still selling for like only 15% less than what we saw in March. So some properties using old comps, the right buyer, things just click. You can still get a property sold. So I still think there's an opportunity to sell right now. In general, I think it's smart to sell and move on to the next deal, but maybe that's because I see so much opportunity. And a property that's fully rented and fully renovated and it's maximized, there's no more value add to it. That property to me is like a low return. Like I don't really want that in my portfolio because I'm getting like a 5%, 6% return. I'd rather just sell it and private lend the money to someone with staying power in the market who's not losing money hand over fist, secured against the properties ideally. Or partner with people. I'm doing a lot of partnerships right now too on flips where I'm bringing a solid operator and I'm being the money partner and we're going up together. Or I'm finding the deal and I partner up with someone who's an operator. And that's a match made in heaven for me right now. So yeah, we'll go to the Q&A for a sec here. The next question up was, do you think CRA will follow suit with the IRS in increasing the tax bracket for incomes? Well, they are increasing their staffing. They are focused on raising more revenue. They have to because of the spending that the Liberal government has done over the last few years. So I think it's very likely that they will raise rates. I think it's very likely that the sentiment in the market supports raising taxes. Inflation plus raising taxes is the best thing for the government. Again, you'll own nothing and you'll be happy, right? That's sort of what they're going for. I wanted to start with this too, but I forgot. I'm going to say it now. What do you do with this great reset? Like, if you're wealthy right now, how do you protect yourself? There is now a treaty signed with, I think it's almost 140 countries now, for a global minimum tax of 15% on corporations. Dubai signed it. Bahamas signed it. You will not be able to escape tax anywhere. So what do? You put your money in a trust. You don't own anything, but you control everything. Imagine if you gave your property to a trust and that trust lets you use that property. It's the same as if you own the property, but now you don't own it. They can't sue you. They can't take it. They don't even know who owns it. A trust over here that doesn't disclose is owned by another trust over here, and that trust over there owns another corporation, and that corporation owns the property. And it's like so many levels sideways. Maybe you don't even own that trust. You're just someone who controls that trust for life. And so you can't even take the money out of the trust. It's there forever, but it's safe because you control it. So there's a way to kind of avoid all this is literally don't own anything and be happy because you still have a yacht and an island and a bunch of properties and cash flow coming in because you're a trustee and you make the decisions. You're the executor of that wealth of money. And have a second passport. Please, for the love of, have a second passport, people. We are learning now more than ever that your country can lock you down in a second and they can take everything you have. China is the new world power and they love that model of government. They love silencing their opponents with a bullet. They love imprisoning. They're the new superpower, not the US. Next 10 years, GDP in China will overtake. China is allied with Russia, basically. India and China it makes sense. India and China should ally. They're more than half the world's population. The US will have no power long-term, right? Just that amount of people. Now there's a counter argument to this, right? People are saying, hey, like, what about guys like Elon Musk who are investing in, all the latest and greatest tech? And at some point, drones will be able to kill the masses in seconds. He could have a private drone army that's as powerful as the government. He could assassinate 1 million people to snap his fingers with 50,000 drones. A drone in the sky you can't see from 2 miles away, just killing thousands of people. That's a possible reality. It's dystopian. I mean, if you're going philosophically, it's dystopian. But private wealth, I think is something that will persist. And there's a real reality where the point I was trying to make is that India, as an example, has a huge population of labor, smart labor. Like, Indian people are really well educated and they value education as a culture. The people are very smart. And they're, I don't be racist here, but like in general, very good at negotiating in business. They love to negotiate, right? And so that cultural negotiation gives them a leg up in business and capitalism. And so there's a lot of things that India could do well, I think, to become a really powerful nation. You're right. I saw a comment there about, not allying with China. They're very different culturally. But it's very much different than here. Like the leftist culture here is like, it's wrong to even ask I'm offended that you even asked for a discount. Like that's the left's like, I'm so offended. They're always offended by everything, right? Snowflake mentality. And they're, the millennial Gen Z cohort is gravitating towards the left. And we're like, well, why wouldn't we be inclusive? And like, whatever, let people do their own thing. Like, I don't care if someone's trans or what. Stuff doesn't bother me. If they're over 18, they want to make choices with their body, cool. Like, whatever. To me, it doesn't matter. I'm a Christian, so like I value a lot of the Christian core values in society, and I see them eroding. At the same time, I feel like Jesus would have accepted anyone. So I don't know. I'm not gonna get into religion here because that doesn't matter. It doesn't matter what my core beliefs are. It doesn't really matter what everyone's core beliefs are. I think it's important to think back to how this will play out for you and for your situation if you're watching this and you're thinking, how do I invest through this? Get a second passport. I like Costa Rica. It's in South America. It's got top 20 healthcare in the world, one of the most biodiverse ecosystems, really nice, beautiful people. There's a real potential here, I think, for West and East conflict, where maybe something happens in Taiwan and Russia backs China and the US goes against, if there's an economic fallout and there's an economic war, it's called an economic war, where China says, hey, we now have more GDP and we're the new reserve currency. Like we are now more valuable than the US dollar. So we start trading in, instead of US dollar, we start using, I don't know, we'll see. I don't know if that will happen, but it could lead to war. Anyway, that's why I think the second passport is important. I think that having a place to go, if you're not in the West or East, I think South America is a nice, safe backup option. And there's great tax advantages. You can live a really great life there. You can have a full staff. You can pay for pest control. If you're worried about that, you don't have to live right in the jungle. You can live on the beach or something, right? You can really have I think a maid for like $3 an hour or something there. So like someone that lives on site in one of the guest houses and just takes care of everything on the property, like literally get everything taken care of. Manana, it'll be tomorrow, it won't be the day you want it. It'll be like 3 days later. The culture there is very much laid back. And anyway, next question. We'll go on to the Q&A and try to get this caught up here because I'm falling behind. So do I think taxes are increasing? Yes. Do I think that they're increasing enforcement too? Yes. Makes sense. They inflated assets. They want a piece of all of our assets. Again, the reason why I like crypto. With crypto, they can't seize it. How? It's on a hard wallet. Okay. When do we see the bottom? So Eric, I wish I knew. So my hypothesis is now seeing what happened with the Fed today. I've believed this for weeks now. You've heard me talk about this. I'm actively short the market. I'm 2-to-1 short the market. So the market, NASDAQ moves down 3.5%. I move up like almost 7%. Maybe not that much. I'm like 1.5 times short. I think that it's important to remember that we're going to test, the 255 QQQ low that we saw, which is another, 5% drop. We're going to retest the lows on the year, the lows in the last couple of years. We're going to test that and we're going to see how far we test that. I don't know where the bottom is. Could QQQ go lower? As soon as we test the next bottom, we go below 255. That's like 37% down on the year on the NASDAQ. I'm going to start nibbling. So I'll go from short to neutral. And then as we continue to fall, I'll probably go to long. I might go to long and then trade the bounce. I shouldn't do that. Shouldn't try to trade or time the market. It's possible we get a bear market rally, which is like we're trajectorying down, but then they have a rally where you go up 20%. So if you're shorting, that can be really painful, that short squeeze, and then further back down because macro data does not support major growth. Companies are suffering right now, and it takes a long time for the pain to be felt. Even though the stock market is forward thinking, even though real estate is supposed to be forward thinking, people are still stuck in everything's going to be okay. And everything might not be okay. We might go through some really painful years ahead. The effects of the hikes now won't be felt till next year, fully. So yeah, that's my thesis. I think protecting your assets, you could hedge in an Interactive Brokers account. You could hedge the downside. You can even hedge real estate. If you have a huge real estate portfolio, you can open, I'm trying to remember the name of the tickers on the ETF. They aren't even levered. You just go buy the ETF ticker. I think it's like I don't know, DXR, DVR. I can't remember what the ticker is. I have to look it up, guys. I got it on all the tickers are on my phone, so I just see them there. But there are directional Horizon ETFs, a number of other ETFs that track real estate in Canada even. So if you're worried, you want to hedge your real estate portfolio, you're like, what if real estate drops 10%? Buy that property that you're thinking about buying, and then go take $10,000 and put it in the hedge. DRV, thank you. You can hedge down. And it's like they're 1-to-1, 2-to-1, 3-to-1. So you do a 3-to-1 hedge at $10,000. And if the market drops 20%, then you're going to make 60% on that investment. So maybe you put $100,000 into a property, you take 20 grand or 50 grand or something and throw it into hedge against real estate. And if you believe real estate's going to fall, you can continue to do that flip, probably still make money, but instead of making as much money, you'll make the rest of that profit from the hedge over here. And the reason I think it's important to hedge is I still love real estate as an asset class, and I might be wrong. That's why you don't ever bet the farm on one asset class. I'm not all crypto, I'm not all real estate. There is something to be said about, going deep on that thing that you're good at. You have a competitive edge in. But again, I'm not entirely sure if it makes sense to go deep on an asset class you can't control. With business, you can control your business. With real estate, you can control the outcome, I think, to an extent better than you can in the market. And so with the markets, I say be careful with leverage, guys. You guys know my dividend portfolio that I talk about where I apply leverage. I also actively hedge. I also, have cash reserves on the side if I have to cover a margin call, right? So that's, you gotta be careful, guys. Don't take on these crazy positions and lose your shirt. The most important rule in whatever you invest in is don't lose money. If you're gonna lose money, cut losses quick. This is where people hold on. They hold on to that property all the way down. It's like they should have sold it and they don't. They don't. And they don't. And they don't. And they don't. Now they're underwater. A 12% mortgage. And they have a private on it too. And they owe everyone under the sun. And now it's the bottom and they're forced to sell. And they should have sold here. Same is true in stocks. By the time it gets to the bottom, and if you short it here, you're at capitulation. Capitulation is the moment at which you can no longer, and I've experienced this myself, even as someone who knows the macro data is bad. I know we're going into a really bad next year. I know the inflation's still crazy. There's war. There's so many things bad happening. We're going through an energy crisis coming up this winter. There's so many bad macro things that are going to happen. The jobs data hasn't even turned bad yet. We're still growing. The US economy is still growing. We haven't even had real contraction yet. We're not even in a recession yet. The real pain is coming. Anyway, but you can be wrong. And I think it's important to, I lost my train of thought. But anyway, it's important to be diversified, to balance your assets out, to operate smartly in this market. Okay, I'm gonna do a rapid fire, try to catch up on all these questions here. And then I'm gonna wrap the stream up and point you guys over to the next stream. Hi, Mike, hope all is well. Love what you do. Is there any way to shorten the amount of time to BRRRR properties rather than the 6-month seasoning period after each BRRRR? Sure there is. You could raise private money and then go to a lender. You don't need a seasoning period at all. You don't have to go with 8 lenders at all. You could go call up Uncle Joe or call up a mortgage broker and say, hey, do you know an Uncle Joe who will fund this at 10%, 12%, whatever, 15%? Maybe this market, it's hard to find capital, so you got to pay more for it. Also, the cost of debt for all these lenders is gone up significantly as well. Their lines of credits used to be at 3, now they're at 6, right? So their cost of funds is doubled. So they're going to pass some of that on to you. If it's a good deal, it still works, doesn't matter. You can afford an extra couple of points over a short period of time before you refinance the property. There is no seasoning. Some lenders don't have seasoning at all. Some lenders are 6 months, some are a year. Some lenders, like Scotia, used to never care. I would buy a property and refinance it right away, and they would just throw in a mortgage on it. They would give me a HELOC for the difference. BMO was the same thing. So I don't know. I was never subject to a conditioning period in the same way. I had heard that though. RBC once told me there was a seasoning period. TD is the same thing. I never liked TD, to be honest. I found their lending practices pretty tight, pretty constrictive. But maybe it's just the person I dealt with. You never know. Thanks, Joseph. Ryan says, tough to decide whether to sell or short-term rent. If you can refi and pull all your invested capital, would you Airbnb, assuming very small cash flows, worst case scenario? Yeah, there are properties that in the right area, if I really like the area and maybe there's some ego involved, or maybe I personally want to use the property. Maybe it's in Florida and I want to use it for a month a year or 2 weeks a year. Maybe there's a cottage that I want to own and I want to use it 2 weeks a year. And I just like to hold that asset and I believe in it long-term. There could be an argument that you could short-term rental it and generate great cash flow. And so, yeah, there's definitely arguments to be holding properties. I'm not against holding properties. It can make sense as a place you want to park some cash, as a safe place to put it. In this market we're in right now, though, there are so many opportunities. It's very, very hard to not want to because you can never refinance all the capital out. Best case scenario, you pull out you're leaving 20% in the property, right? There's always the 20% equity you've left in the property. It might be created equity. It might be fugazi, not real, right? You've gotten all your money out, your renovation money, everything you put into it's out. And you've got a profit maybe even. If you refinance at a high enough valuation, you might be in a situation where you got no money in the deal, but there's still technically money in the deal. Your money, your profit that you made by putting in the hard effort of finding that deal under market and turning it around and transforming it. So yeah, it's tough. There's nothing wrong with buy and hold real estate. In this market right now, there are so many screaming opportunities. It depends on what you can sell the property for as well and what your carrying costs on the property are. If it's cash flow positive, throw on a short-term rental, and you can get your cap rate from 6 to 16. At 16, that's interesting. I might hold that property. So there are ways to get the cap rate up to get a great value. Like there are certain markets where people don't value Airbnb and the market rent's low, but you can get triple the market rent on Airbnb or doing corporate retreat rentals, furnished rentals, et cetera, so forth. So there are ways where, you can keep the property if the cash flow is high. Like someone from that Toronto example I used earlier, let's say they're getting $24,000 a month on that property on Airbnb. I'd be like, okay, it's worth $2.5 million. You're holding it for $24,000 a month. You're hugely cash flow positive. Okay, I can see the argument for holding that, especially with a tax shield that you don't have to sell it. You can keep all that. If you bought it so low in that example I used earlier in the stream, you'd have a huge tax shield that you get to, you've pulled out more money. There might only be the only money left in that property with such a huge, like that's like a quadruple in that example I used, or like a triple. In that example, the tax owed on that property might be all the equity left in it if you refinance at 80% loan to value. And in those examples, you hold that property. You don't sell. Like I said, there are tax examples where you might hold. If you bought it 10 years ago, it's appreciated a ton. The equity in it might be the tax liability only if you sold. The 20% left in it at the new refinance value. So in those cases, you hold and you maximize the cash flow on it. So there are definitely arguments to hold. And I was just focused on people who bought like a year or two ago and they're like, I'm gonna keep this property forever. There's emotional reasons sometimes, or maybe the property's under levered. Another example, a lot of cash trapped in it. That's what you don't want. So you gotta relever or sell it. I think relevering is a great strategy and it's a great point. Next one. By the way, there was like 100 people who jumped in here and I don't see 100 likes. So there's even 70 people on right now and I don't see 100 likes. So smash that thumbs up button right now if you can for me. I'd appreciate it. It tells the algorithm that you got some value today. It's like when someone speaks on stage and you clap after. It's just polite to hit the thumbs up button. Have to decide whether to sell or short-term rental. Okay, so we did that question. Next one was Canadian Real Estate Channel. So Canadian Real Estate Channel, at the end of this stream, I'm going to end it in just a sec here. I'll send you guys over. I think they're doing a live stream every Wednesday after mine. So I'll pump the 100 people that are watching this and the 1,000 people after that watch it. Go check out that live stream if you want. It's run by, I think it's still run by Matt McKeever. He's at least one of the controlling, he was the founder. So I don't know if he still operates it every day. I think Peter's more operating it daily, but great guys. And overall, just a lot of great content if you're interested in real estate investing. So check that out. Shameless plug for them. Getting paid nothing. It's just friends and just being nice. REI, hi Mike, how's the arbitrage life? It's good, thank you. I like to arbitrage everything, wherever I can. Hey William, evening Mike, Meta at 91, I know, pain. Sad Elon took Twitter private, me too. I think he's doing a lot of great things. He overpaid for Twitter. It's the reason I didn't buy Twitter as it hit $45 a share, $50 a share. It went private, and if you bought at that price, you might have taken a loss. I think you buy for what, $53 a share or something? $54 a share. Sebastian says, let's go, guys. And oh, by the way, sorry for this hideous rat on top of my upper lip. I'm doing little fundraiser, little thing for men's health, if you guys know, Movember. So I do it almost every year. I think I've had a mustache every year for the last decade. Sometimes I do the goatee too, or I just, there's always something on the upper lip throughout Movember. And so for this year, I shaved off my beard and I miss it already. I miss it. But supporting men's health, like mental illness among men is like triple than among women. So men struggle, prostate cancer, just in general, cancer awareness, men's health awareness. So I will set up a link on, if you message me, I can give you the link to donate. And I'll probably do a post about it too. Mason says, 400 to 500,000 immigrants. Next year, 500,000. That's right. There is a huge pool of immigrants coming into Canada. I wish there was more qualified immigrants coming into Canada as opposed to refugees with 6 kids that are coming here to drive taxi on the side for cash and then collect Canada Child Benefit. When you come here as a refugee, you can, if you have like 5, 6 kids, you get $6,000, $7,000, $8,000 a month from the government, tax-free. It's the same as if you're coming here and getting a job as a doctor, but you don't have to work. You just sit at home on your ass. You get handed a whole ton of money. So that program has a lot of flaws. I would like to see, and I get they're trying to incentivize people to have kids, but when people come here and then abuse that system, it's not so great. They're taking a lot more than they're giving. and I would love to see them bring in people who are going to contribute value to society. I don't mind investing in people, but I want to see that ROI back. And again, you have to make 100 grand a year or more to pay enough tax to actually contribute positive to society. So don't forget that, guys. That's right. You could do a trust. You could just have trusts set up that own everything, that own another trust, and you're just basically advisory or in the executive role. You talk to some really good lawyers who can write stuff up, especially if you use the trust not in Canada. So you'd want to set up a trust in like, maybe not even Dubai, but some like random country that is known for it, like maybe in Switzerland, as an example, right? Like the Swiss are known for their privacy. That then owns a Dubai Corp or something, because they don't release any data on who owns what. So the government can't even find out what you're doing. There's levels of privacy there. I haven't set any of that up yet, but something that I should look into as I get wealthier. It will be something that on my journey to billionaire, I'll have to confront and deal with. And I think it's important that a lot of us have those backup plans in place, because they can't tax what you don't own. If it's not an asset, it's technically, you get benefit from it, but it's not an asset, right? It could pay you even an income. It's like a job. But again, if that income is paid out to another country and that country has no tax liability, I mean, there's some interesting structures you can use still to this day. Places like Ireland didn't sign the treaty as well. There are certain places where like they just said no to the corporate 15% minimum tax. Would you go variable or fixed rate right now on a primary residence, no plans to sell? So I think, like I said last stream, 2-year fixed is the way to go. It depends on the rate they're offering you. 1-year fixed, 2-year fixed, 3-year fixed, in that range. I wouldn't do 5-year fixed, too far out, paying too much and locking in too high of a rate for too long. I think there's a good probability that next year gets worse, 2024 gets better, and so you're up for renewal in 2 years. Remember, with a 2-year fixed mortgage, you have the option to renew at 1.5 years, no penalty. 6-month early renewal. All the major banks offer it. So when you lock in for 2 years, it's locked in for 2 years, but you can always renew at 1.5 years if you want to. So I like the 2-year because it gives you the most flexibility and the lowest chance of loss. Chances are rates will be down 2 years from now, maybe 1.5 years from now if we get lucky. And then you can refinance if you want to, or you can keep it going. So I think it's better to, through these next times, variable will get a little bit worse. If you had locked in, been smart. As we get to the top of rates into the next year, I think it'd be better to go variable and not lock in. But again, it depends on how you think things will play out. Do I support the Great Reset? No, hell no. No. I think everyone should be free to do what they want. And I think that, this whole, universal basic income and anyway, although there is some merits to universal basic income, I just don't like the fact they're going to take, anyway, I don't want to get into the Great Reset. I put it in the title because I thought it was clickbaity. That's right. Thank you, Victoria, for that point about India not aligning with China. But again, they are both very large powers. Part of their culture, you're totally right. Next question. In Canada, how do I protect my money? So you protect your money by, there's a lot of ways to protect your money in Canada. You can set up trusts here too. Crypto is always an option. You could give it to your parents, as an example, and have them buy a house. And you could buy your parents' a house, both your parents' a house. And now they have a primary residence that's tax-free. They're not coming after your primary residence in Canada. Not anytime soon. Majority of Canadians have that as a goal on their bucket list, right? Late stream, but good evening, Mike. Hey, Will. Welcome to the stream. Default name says, what advice would you provide when buying real estate from a wholesaler? Do your due diligence. A lot of the wholesalers these days are overselling the properties, and you can get a better negotiated deal in MLS than you can get from the wholesaler. They have good marketing channels. You want a wholesaler who doesn't have a robust buyer's network. You want a wholesaler who has a bad buyer's network. And they're good at finding deals, but they can't get rid of the deals. You can negotiate with the wholesaler, get their fee down. In this market, pay them $5,000 for a wholesale fee. They can't demand $40 anymore. They're basically a glorified realtor. They're trading in wholesaling is a lot like trading in real estate. And in this market, that's a lot more difficult of a business to run. So I think that this is the market where I've seen a lot of people still paying crazy wholesale fees and overpaying. Run your numbers, make sure you know it cold. We see the bottom when DXY is at 120 and 2-year bond is at 5% with VIX at 50. Jeez, Monster Pig. VIX at 50. That is a good, people historically say that the VIX over 45, I've even heard over 40, is close to where we see the bottom. volatility index is the VIX, by the way, guys. So you can check the VIX anytime to see if it's spiking. It's pretty low right now, so we're on our way down. I feel bad that I hedged before today's meeting. I went and bought a bunch of calls, and I sold some puts on the index to cover my short. Not all of it. I'm still short, but I would have been 3 times short if I stayed this morning. But I got scared. Right as soon as the Fed started talking, the market rallied like 1% up, and I was like, oh no, 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 no. So I just hedged. I was like, I can't watch. Hedge, and I'll look back at it in a minute. I looked back, I was like down 2%. I was like, oh shit. Just lost like 50 grand hedging. But it helped me sleep at night. You know what I mean? Like I wouldn't be able to sleep. No, if it had gone the wrong way and I lost 100 grand, it would have stressed me out. So I don't mind paying, I think all in all, 20 grand to hedge. It's like I made 125 today. I would have made 150. Didn't make as much, but I felt better about, not being as exposed. Why would a seller choose to contract with a wholesaler? There's a lot of reasons why. They might, they're embarrassed. They don't want to put an MLS. They don't like realtors. They don't want people going through their house and picking through their stuff, and they have a distrust for that whole process. They want an easy, clean sale, and someone walks in and says, hey, I have an offer for you. I've sold my property privately. I sold several of my properties privately for like $50,000 less than what they're worth because it was easy. Because I knew that the person buying it was going to give me a firm offer. I didn't have to worry about anything. Why people accept conditional offers from wholesalers with partner approval clauses that they can just walk away on and tie up your property for 2 weeks and waste your time, that's just the fact that most sellers that wholesalers are taking advantage of don't know. And they don't have any other option. They might not even know any realtors. They're like, who do I call? Like, I don't know anyone. I want to sell my property. I don't even know what it's worth. And the wholesaler comes in here and is like, hey, this is what your house is worth. This is the most I can pay. And they're good negotiators. And so that's why people sell to wholesalers. But sometimes it's just because they want an easy, clean sale. Sometimes there's a nuance. Like a lot of times the kitchen's ripped out. And if you list a property on the MLS, people can't finance a property with the kitchen ripped out of it, or it has a bathroom torn apart, or the drywall's all exposed, or some insulation exposed. You can't get A-lender financing on that. So you need a specific small buyer pool. And it's difficult because you have to disclose everything on the MLS. But to a wholesaler, you don't have to disclose anything. There's no obligation. So you just lie. And so that happens too. So be careful on those wholesale properties, because sometimes the sellers are selling to wholesalers for a reason. They couldn't sell it because it was an undisclosed issue and they didn't want to disclose it, so they sold it to a wholesaler. The wholesaler either doesn't know or doesn't have an obligation because, again, they don't have a licensed regulating body that watches them. They can do shady shit. So be careful buying from wholesalers. There are good wholesalers. I love wholesalers. I think they provide a need in the market that is filled by them, and that's why they exist. But be careful. There are a lot of deals that are bad by wholesalers too. So not everything wholesale is great. Sometimes MLS negotiated deal is better than wholesale. Troy says, as interest rates continue to rise, do you think any GIC rate would tempt you, or would you always choose other forms of investment? Troy, I think for me, as rates rise, I can just get more in the private mortgage market. And so if GICs go to 12%, I'll get 24 or 20 or 18 in the private mortgage space. Now, I gotta be really careful about analyzing those deals to make sure that they're of an equal risk caliber. Again, the market's fallen a lot. So we've already saw a 30% drop. So appraised value now, if you land on 70% of that, you're really landing like at 40% loan to value or 50% loan to value of where we're at the peak. And I think that's a lot safer. It's more like GIC level chance of not being able to recoup your money. So no, I don't think GICs would tempt me. There's a part of me who's like looking for a whole life or universal life or whole life provider that is locking in rates now. Let's say that all their funds are front loaded and they can lock in like all of their fund at these high rates. So over the next 3-4 years, they generate an 8 to 12% tax-free return. So there's some interesting whole life stuff you can do because they're really tied to rates, right? And as rates come down, you can lever those whole life policies up, borrow against them, pull all your money out of them, still have $1 million in a policy growing tax-free for life, and have the whole life insurance as a bonus, but basically borrow back all the money out of it. And if it's growing at 12% and the bank's gonna, let's say rates fall and prime falls back down to 3-4%, then you can borrow at 3-4% while it's generating at 12 tax-free. That's huge. You write this interest off. So it's really, you're paying half of that. If rates are 4%, you're paying like 2%. So there's a huge spread there. When you lever that up, 5 to 1, because you can borrow against policies, 10% down, so 90% back. So you can lever 10 to 1 effectively using insurance products. So there's some cool insurance products if you can drop the fees using some term products mixed in with it, so you get a high cash value in early years. That would be how I would invest at the peak of rates. I am interested in investing in those insurance options if I stay in Canada. Any business ideas? Nothing off the top of my head, I'm sorry. Jazz Raj says, what's the minimum needed and way to start lending? So typically you would need like 6 figures to lend. People will take less, but it's not worth your legal fees and all the stress and stuff to find someone, but I'll take your money. I will secure your money against flips that I'm doing at low loan to values for, if you want to make like an 8 or 10%, super, super safe. I will definitely not pay more than 11%. I know some flippers are paying crazy. I got to stay to my numbers. I'm a low risk investor with a lot of cash. And the reason I can command a lower rate of return for the lender, from the lender, I suppose, is because I'm such a low risk, right? You can go get 15 somewhere else, but you might lose your money, right? Is it worth suing? I've never been a suing type of person, but maybe. Okay, I think I'm through all the questions. Curry says, bro, you got long hair now. True, you get a haircut. It's been a good minute. I've been enjoying the flow. I'm like, you know what? Like, just let it go. It's like a year and a half. I trimmed the front a little bit because it was getting in my eyes. But I actually need to wash my hair. It's pretty grimy. Reliable accountant. I can't. My guy's like overwhelmed. Message me offline. I could give 1 or 2 references away to some people that I know. Anyway, that's the end of this stream. Thank you everyone for watching. Remember to go over and check out the Canadian Real Estate channel. My friend, just type in Matt McKeever and you'll find his live stream. I think he's doing one tonight. I don't actually know if he's doing one tonight. Go check if they are. You know, when you get there, say Mike Rosehart sent you. That's my favor. If you go there tonight and check it out or whatever, in the comments say Mike Rosehart sent you over there. Just want them to know that I care and that, try to support those in the group. So, yeah, you want to support all the people that they're trying to do this too, right? If you have friends in the industry, you don't ask them for a discount. You ask them, how can I support you? How can I buy your products and services even if I don't need them, just to support you? That's what you do. It's the right thing to do. Anyway, the secret to unlocking wealth here. You guys, 3 levers to control your financial future. Spend less, earn more, and maximize returns in the difference. Remember, follow along at Mike Rosehart on Instagram and Mike Rosehart on Facebook. You'll find me with a blue check mark so you can follow along. The other accounts that are under that name are fake. Look for the blue check mark. All right, everyone. See ya. Every week. See you next week. Live at 7 Eastern.